if people had known at a certain point in time, what was the trigger that would allow people to know this is my exit strategy?
Look, every time you invest in something, one, you need to know what you're investing in, correct? So a company is a great company at the price. You cannot just buy any company at any price. So the important thing is to know when to enter, correct? But as you enter, you need to make sure you have an exit strategy. Now, in the book, there is also the principle of adaptation and learning, correct? So there is an element of learning and adaptation that always needs to be there, correct? Because even your strategy, if that strategy proven to be a strategy that needs to be adjusted, you need to have the courage to adapt and adjust, as you learn along. So for me, is the starting point is you invest in what you know and you invest in the businesses, because at the end of the day, buying stock is your buying portion of the business, correct?
So if I'm a technology guy, I wouldn't go and blindly buy from the, let's say, pharmaceutical industry, for example, unless I go and educate myself about that industry first.
Yeah. Look, it doesn't matter who you are. You only need to invest in what you know. I mean, it's probably a traditional wisdom. I mean, don't invest in something that you don't know. Now, if you're a technology guy, I think it would be much easier for you to understand the fundamental of a technological organization. But you can also improve your level of competencies in healthcare and pharmaceutical and others as well. So that doesn't mean you cannot invest in other sectors and industry. You can, but you need to make sure you understand what you're investing in, correct? If I ask you a question, why did you buy, company A? You need to be able to tell me in maybe just a matter of few seconds, a good reason why you bought it, rather than, the price was going up and I bought it, or my friend told me and I bought it. That's not a good reason to buy a company.
So in your book, for example, you say that you'd rather at some points in time to buy a stock at $300 from a company rather than buying, company A, let's say, has a $300 stock. Sometimes it's better to buy that stock rather than buying a $100 stock from company B. Is this related to?
Yeah, look, when you buy a company, you need to put a value on the price, correct? And to put a value on the price, there are so many things you need to understand about the business that you're buying. Obviously, what line of business they're in, their competitive landscape, what's the innovation pipeline they have, the leadership team on board, the futuristic value of the organizations, and so on. Maybe some of the trends taking place, if they're actually, for example, they're going to be impacted by laws and regulations. So you need to be able to understand the full pictures of the business you're actually trying to invest in. So price itself does not determine the decision to actually buy an organization. And whether it's 100 or 300, it's irrelevant, correct? Because, today, if you take Amazon, I'll buy Amazon with a blink of an eye if it goes down to 300, correct? But I wouldn't buy so many companies at a fraction of that as well.
So the rationale is, study multi-factors, all the variables that goes into what's the value of that share, in addition to its price. But that's a very small kind of decision element across all of the other variables. Once you put it into that formula, then the decision will go into buy and not buy. The problem is people deconstruct and simplify the formula into this is a 300, this is a 100, probably this is cheap, so let me buy 100 from that instead of 300, which that could close tomorrow and file for bankruptcy or whatever.
Yeah.
And that's the rationale. Yeah. Okay.
Look, the objective when you buy something or investing in a business, you invest in a business because you believe it's going to grow and it's going to give you higher value from what you invested in, correct? And that's the essence of investment. You buy something with the expectation is going to appreciate over a period of time. So if you buy something at $100 and you know it's not going to appreciate, if anything, it's going to lose its value, it would not be wise to actually invest in that company. But if you buy something at $300 and if you believe it's going to actually appreciate by 20, 30, or even 200% in the next few years, that would be investment that would be definitely interested in.